Welcome back to the Daily Crypto Roundup. And today we've got one of those episodes where the individual headlines matter, but the bigger picture matters even more because when you stitch these stories together, what you really see is crypto pushing deeper into the financial mainstream at exactly the same time as the market itself is becoming more demanding, more selective, and in some areas a lot more fragile. We're talking about Bitcoin showing signs that the market under the surface is thinning out. Charles Schwab moving closer to direct spot Bitcoin and Ethereum trading. The Ethereum Foundation making a major treasury shift by staking roughly 70,000 Ethereum. X preparing a new anti-scam feature that could auto-lock accounts the first time they post about crypto, and even the stock market starting to move in a direction crypto people have understood for years, which is that round-the-clock access changes the entire game. Before we get into it, this episode is brought to you by Kraken, which is now the official partner of the show. And the reason we're happy to work with Kraken is simple. When you're in crypto, the exchange you use actually matters. You want deep liquidity, strong security, a platform people know, and tools that don't make you feel like you're using something built overnight in a rush just to cash in on a bull market. Kraken has built a reputation over years in the industry. It gives you access to a wide range of assets, and for a lot of people it feels like the grown-up exchange option in a space that still has too many cowboys in it. So if you've been listening to the show and you're thinking about where to buy, trade, or get your feet properly under the table in crypto, have a look at Kraken through our link in the description, because it supports the show and it gives you an exchange we're genuinely comfortable mentioning. Let's start with Bitcoin, because this is one of the most important stories of the day, and it is not the kind of story that gets everybody screaming on social media. But it is exactly the sort of story you need to understand if you want to know what this market really looks like beneath the surface. The warning from the latest market reporting is that Bitcoin is thinning from the inside. In other words, even if the chart doesn't look catastrophic at a glance, the structure underneath may be getting weaker. Some of the data being highlighted shows overall Bitcoin demand contracting by around 63,000 Bitcoin per month, while large holders have distributed close to 188,000 Bitcoin over the past year. That is not the profile of a market being powered by broad, aggressive, fresh demand from all corners. That is the profile of a market that is increasingly dependent on a narrower set of supports. And this is where it gets interesting, because a market can look far healthier than it really is for quite a while if the remaining buyers are strong enough. That's the danger here. You can have Bitcoin holding up reasonably well, maybe even grinding sideways in a way that feels stable, while underneath the surface there is less organic participation, less broad appetite, and more reliance on a smaller group of players to absorb supply. That is what makes a market fragile. Not dead, not doomed. Fragile. Because if there is a shock, if ETF flows soften again, if macro turns risk off, or if one of the bigger support pillars steps away for a moment, there is less underneath price to catch it. And that's why this story matters so much. It is telling you that Bitcoin may not be weak in the obvious way, but it may be weaker in the dangerous way. Now set that against another story that on the surface sounds extremely bullish, and that is Charles Schwab planning to launch direct spot Bitcoin and Ethereum trading in the first half of 2026. This matters because Schwab is not a niche crypto-native platform trying to look respectable. Schwab is one of the giants of traditional brokerage. So when a name like that moves toward direct spot crypto trading, you are seeing another wall between traditional finance and crypto come down. The plan appears to be for Bitcoin and Ethereum to be the starting point, and the rollout sounds like it will begin in stages rather than all at once. But that doesn't change the significance of it. And this is where the market gets really fascinating, because you have two truths sitting right next to each other. Truth number one: Bitcoin demand may be thinning internally. Truth number two: the mainstream pipes for capital keep getting wider. That means the current market may be more fragile than it looks, but the long-term access story is still improving. Schwab launching spot Bitcoin and Ethereum does not mean every traditional investor suddenly piles into crypto tomorrow morning. But it does mean one more massive brokerage ecosystem is preparing to make crypto feel normal, easier to access, easier to buy, and easier to hold inside an environment traditional investors already trust. That matters because adoption is often not about hype. It is about friction. The easier crypto becomes to access through platforms people already use, the more natural it becomes for money to find its way in. And when you think about that, you start to see how the next phase of crypto may differ from the last one. The old cycle was dominated by native exchanges, native communities, and speculative mania flying around Twitter and Telegram. The new cycle could be much more about integration, Bitcoin and Ethereum gradually becoming ordinary menu items inside the very brokerages and financial platforms that millions of people already have accounts with. It might not look as dramatic as a meme coin run, but in many ways it is more important. It is the infrastructure of legitimacy being built in real time. Now let's move to Ethereum, because this is one of those stories that is definitely bullish in a structural sense, but maybe not quite the instant breakout signal that some people want to make it sound like. The Ethereum Foundation has now moved to stake around 70,000 Ethereum from Treasury, and that is a major shift in how it manages its balance sheet. The broad idea is simple. Instead of depending so heavily on Treasury sales to fund operations, the Foundation can now produce yield from its own Ethereum holdings and redirect those rewards back into Treasury. Depending on yields, that could mean millions of dollars a year in additional operating support. That is significant because one of the recurring criticisms of Ethereum over the years has been that the Foundation sometimes felt like an overhang. A large holder that, at times, could sell into strength and become a source of market anxiety. Staking changes that perception. It does not eliminate every concern, but it does send a much better signal. It says the Foundation is leaning into Ethereum as a productive treasury asset, not just something to occasionally liquidate. It tells the market that Ethereum is not merely being talked about as a yield-bearing long-duration digital asset. It is being treated that way by the people sitting on one of the biggest and most symbolic treasuries in the ecosystem. But here is the key point. Confidence signals do not automatically break resistance. If Ethereum is sitting around the low 2000s and struggling to push higher, Foundation staking alone is not enough to suddenly force a breakout. You still need demand. You still need buyers. You still need market conditions that encourage people to take risk. So my read on this is that it is quietly bullish, maybe even importantly bullish, but not explosively bullish. It strengthens the long-term story more than the short-term chart. It helps Ethereum look more mature, more aligned, and more self-supporting. But if people are expecting one treasury shift to light a fire under price all by itself, that is probably too simplistic. And Ethereum has this pattern over and over again. Some of its strongest developments are not always the loudest. They are slow burn developments. Better treasury behavior, better institutional framing, better staking alignment, better infrastructure. These are the kinds of things that do not always create instant fireworks, but they create a stronger platform over time. So when you see the Ethereum Foundation stake this kind of size, that is something serious investors will notice, even if the broader market is too distracted to fully price it in today. Now let's talk about X, because this is a very modern crypto story. Not a price story, not a protocol story, but an internet plumbing story. X is reportedly preparing a feature that would auto-lock accounts the first time they post about crypto, or at least the first time they mention crypto in that account's history, with verification then required before they carry on. The logic behind it is actually pretty straightforward. One of the most common patterns in crypto scams is that an existing account gets hacked, hijacked, or repurposed, and then suddenly starts posting token promotions, wallet-draining links, fake giveaways, or urgent messages designed to exploit trust. If a platform can detect that sudden shift and force verification before the content spreads, it cuts down the usefulness of the hack. And honestly, whether people like it or not, that probably makes sense. Crypto scam culture has been a disaster for the space. Every time a celebrity account gets hacked, every time a known page suddenly starts shilling a fake token, every time someone loses money because they trusted a familiar name, it damages the whole ecosystem. It makes crypto look amateur, unsafe, and manipulative. So from that angle, X trying to build a scam kill switch is actually a pretty smart move. It is not anti-crypto, it is anti-hijacked account pretending to be crypto. Now, of course, there are trade-offs. Legitimate users posting about crypto for the first time could end up being inconvenienced. People will probably complain. Some genuine accounts may get caught in the net. There will likely be edge cases and messy implementation issues. But the broader principle is sound. If the internet is full of bad actors exploiting the same playbook over and over again, platforms eventually start targeting the playbook itself. And in this case, the playbook is pretty obvious. A previously normal account suddenly starts pushing crypto. So I actually think this story is bigger than it first appears, because it shows that social platforms are being forced to adapt to crypto-native scam behavior in very specific ways. And that matters because one of the next frontiers for crypto adoption is trust infrastructure. Not just custody, not just regulation. Trust. Can people interact with crypto online without constantly wondering whether everything in front of them is fake? Can they click a link, follow a post, join a discussion, or watch a market conversation without feeling like they're walking through a minefield? The more the platforms themselves start responding to these issues, the more survivable the space becomes for ordinary users. That may not sound glamorous, but it matters. Now, the final big story I want to touch on is one that seems like a stock market story on the surface, but actually says a lot about crypto's influence on financial markets more broadly. There is growing momentum behind much longer stock market trading hours, effectively pushing toward a more continuous model that would reduce the traditional distortions of after-hours and overnight price action. The argument here is that when markets are closed for large stretches of time, or only semi-open in thin overnight conditions, price discovery can become messier, thinner, and easier to push around. Crypto solved that in a different way by never closing in the first place. Whether you love crypto or hate crypto, it got one thing across to the wider financial world very clearly. Markets do not need to sleep just because legacy systems do. And now the stock market is increasingly moving that way too. Not fully 24/7 yet, but the direction is obvious. More access, more hours, more continuity, fewer giant artificial gaps between the close and the next open, fewer opportunities for weird overnight moves to completely define the tone of the following day. And for traders, that matters. For global investors, that matters. For anyone outside US time zones, that matters. The old structure of wait for New York to wake up is starting to look outdated. And that is why this story belongs in a crypto roundup, because this is one of those moments where traditional finance is quietly admitting that crypto was right about something. Continuous access changes market behavior. It changes who can participate, when they can participate, and how prices form. It makes markets feel more like living systems and less like shops with opening times. That does not mean all manipulation disappears. Thin liquidity can still exist. Strange moves can still happen. But the broader idea is that the more markets move toward continuity, the less power there is in those dead zones where only a few people can really act. So the takeaway today is this. The crypto world is winning the long game in a lot of ways, but the short game is still a test. Stronger rails, stronger legitimacy, stronger integration, but still a market where you have to respect weakening internals and selective demand. That is where we are. Not broken, not euphoric, transitional. And sometimes those transitional phases are the ones that matter most, because they tell you what kind of market is being built underneath the noise. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.